Hi everyone, welcome to 23 Mile with me, Kayode Odele. Today I'm joined by Eric Peck, currently the co-founder and COO of Vissibl. But his CV before co-founding Vissibl reads like a movie script. He's a former Australian Air Force pilot. He was a management consultant for a few years, and thereafter founded one of the world's first drone delivery companies, which ended up raising about $30 million in venture capital, went on to achieve the very first vaccine delivery by drone, and then scaled the company to a $100 million acquisition. But the story gets interesting from there. From the highs of the fundraising and the acquisitions, the company crashed. He had a burnout, restructured the company, and is now onto something else. On the show today, we'll go through this remarkable journey, and Eric will share insights on scaling, learning, speed of execution, fundraising, surviving burnout, and coming back stronger. Eric, welcome to the show.
Thank you very much, Cody. It's a pleasure to be here with you today.
You've squeezed in many lifetimes of achievement into one. Let's start at the very beginning. Tell us about growing up in Australia.
Yeah, definitely. So I grew up in a city in Australia called Melbourne. And so that's renowned for having 4 seasons in one day. We have very hot summers, we have very cold winters, and everything in between as the seasons move through. As I was growing up, I used to love pulling apart lawnmowers or making models of things or rockets or like building different things. And I think that kind of set off an inquisitive nature of wanting to do something a bit different to the fray. Um, and so naturally, with my parents, both accountants, both business people, uh, I didn't follow in their footsteps and I joined the Air Force.
I had a childhood dream of either being in the Air Force or being aeronautical engineering, but you lived that life. How did you end up getting into the Air Force?
I think it had been a lifelong dream to join the Air Force and be a pilot. I recently read my year 6 end of year book, and in my very terrible handwriting, I'd written that I wanted to be an Air Force pilot and then an astronaut. And so, as far as I can remember, I'd wanted to be an Air Force pilot. And so I went through high school. I actually learned to fly. So I had a job at a juice bar in Australia, and then I took that money and I used it to pay for flying lessons. So I had my recreational license when I was 15. That's the youngest age you can get a recreational license. And I couldn't drive myself to the airport, but I could fly a plane, between a capital city. And so it's kind of this crazy mentality. And so from a very young age, I kind of graduated from remote control planes to recreational aircraft to like a private pilot's license. And then ultimately I joined the Air Force just after my 18th birthday.
Planes. Were you a fighter pilot or were you flying transport or airlines for the transport?
So back when I joined the Air Force, we thought the brand new fighter jets were going to turn up in 3 or 4 years' time, made by Lockheed Martin. It's called the F-35. And so I got accelerated through a university degree in 2 years. I did basic flying training, advanced flying training. I was one of the top graduates on my pilot's course and was then pushed onto fighter training. But I got airsick when I was flying the jet. And it's very hard to fly a jet, work a radar, and throw up at the same time. And so I wasn't very good at it. Is the actual answer. It was just the combination of things was too much, as it turns out. In fact, I broke the speed of sound, I think the day after my 21st birthday, which was really cool, in a jet called the Hawk. That was a pretty cool experience, and you kind of had to climb as high as the jet could go. You rolled it upside down and then pointed it basically at the ground, put the power up all the way, and that was your first Mach run. Super cool. The jet's shaking, and the little numbers on the screen, can up, can up, can up. You get it just over the speed of sound, pull the power back, and pull it up over the ocean of Western Australia. It was super cool. So that was great. That was an experience to have at 21. Being given the opportunity to do that, do some amazing things, jumped off the fighter jet in the Air Force, and I flew an aircraft called the Hercules. And the Hercules is a combat transport aircraft. It's got 4 engines. Often they're painted in kind of green or grey camouflage colors. We could put about 100 troops down the back. They're around about the exact same dimensions as a Boeing 737. And so I flew them at 37 Squadron based out of Sydney in Australia. I did some really cool stuff. I did 2 combat tours of the Middle East while I was flying those. Again, I was really young. I qualified to be a captain just on my 25th birthday. I was pretty proud of that. So that's a pretty young age to be given a 70-ton aircraft worth, $100 million. You can have 100 people down the back and you can take it anywhere in the world to do everything from a mission, low level, 50 meters off the ground, 500K an hour, wearing night vision goggles at night, flying this thing, doing radar avoiding type missions, all the way through to putting 40, 50 people down the back, flying an aircraft 4 hours over the Pacific Ocean to an island that's just been struck by a hurricane, and being the first people on the ground to deliver humanitarian aid. I did everything in that bundle while I was flying there. And that was kind of my Air Force career.
Amazing. I can imagine over this period, you must have done a lot of interesting things, like you said. Is there anyone that stands out that is okay to share?
Listen, that mission I was just talking about
Yes.
into the Pacific Island, in 2015, there was a cyclone called Cyclone Pam, and it basically decimated an island nation in the Pacific called Vanuatu. And it's really well known for a holiday destination, but there's an archipelago island nation, and it was completely decimated. And so we took off out of Australia. We loaded the aircraft up to its maximum weight. We had to climb very slowly, narrowly avoiding the city of Sydney, and then out over the water we climbed up. We put our night vision goggles on. We had to do runway inspections and make sure it was safe. We could put people out on the ground. And ultimately, we flew out to this island where we had a point in the flight where we didn't know whether we were going to have enough fuel. If we got there and we couldn't land, we didn't have enough fuel to get back to Australia. And that's a pretty cool thing to have done. And you go, well, if we can't get on the ground and make sure the runway's clear, they're going to run out of drinking water in 2 or 3 days. We landed in there. We actually got all the cargo off, and the runway was cleared. And the next day, the big aircraft started coming in and being able to land. And that was a mission that we were able to do because we were trained, and the aircraft would land on, a broken runway if it needed to, with the people needed to fix it for the bigger aircraft. And so that's what I love to talk about. It's probably my favorite thing to have done.
This brings back memories for me as well. Nigeria has had the C-130. We used to see them come in and land. They had this short takeoff and landing.
Yeah, definitely. So we could come in and we could like slam on the brakes, and we could land in a very, very short distance if we needed to, which is super cool. So about 1,000 feet, so 300 meters, we could probably get the aircraft down if we really needed to in terms of the minimum absolute distance. But the kind of cool thing was alongside that, so that's a really tight area. Like a commercial airliner might take 8 or 9,000 feet. It's a really long distance, so we could really get it down. But we could also land in like mud or sandy conditions, or all on dirt runways that have rocks on them. It was a pretty exciting thing to do.
Thanks for that on the mission on Vanuatu. We'll come back to that because it shows up again in a very remarkable way in your life. Very early on as well in the Air Force, you were a captain and a leader at a very young age. What was this like?
As an aircraft captain, you're given the responsibility not only over the physical asset, the airplane, but the crew that are going along with it. What you learn when you're given responsibility at a really young age is you need to gather information from all the people. There's people out there with experience, have seen different things, but leadership style where you've got to drive the team. Often you're doing very hard things. And so how do you get this group of people together behind the mission you're running? That's what I learned leading at a young age. We often had people from completely different backgrounds that have a family and 2 kids, and they'd be 40 or 50 years old with 25 years of experience. And here was me, the boss, technically in charge, 5, 6 years into an Air Force career. It's a pretty unique place to be.
What made you leave after just 9 years?
I'm a pretty ambitious kind of guy, and I knew because I had an injury, I wasn't going to be able to fly forever, which meant that bit of running the mission wasn't going to be what I would do, for much longer. And so I made the decision, hey, what is life going to look like beyond the Air Force? And so I did an MBA. My parents both worked in business, and so I thought, you know what, I'd love to learn a bit more about that.
Yeah.
And so the last couple of years I was in the Air Force, I did a business degree, which was tough. It is tough to study and work at the same time, but I got through it, and it was kind of that drive to go and explore what was next. I was just always really driven. What was that next hard challenge I could do? My forever job was running a mission, running a team, taking a group of people and going and doing something really tough. And I thought, hey, I've done this in the military side. Let's try it. Let's see what the business world has to offer.
When you left the Air Force, did you have anything lined up, or it was just, okay, let's go see what's next?
It's a little bit of both. So when I made the decision to leave the Air Force, it took about 3 months to actually jump out. And I didn't have anything necessarily lined up. I just finished my MBA, and I did the last 2 subjects of my MBA at Beijing University. And that was focused on trade between Australia and China. They were our biggest trading partner at the time. Really, really good relations. This was the peak of Sino-Australian relations at the time. And so I explored lots of different business ideas when I left the Air Force. Could I export beef and lobster to China? Could I set up a school to teach English to Chinese students and then bring them out and run a visa service for them to study at Australian universities? There was a range of different things I explored. And I did, in fact, export some beef and lobster to Australia. Ultimately, what happened is I think I want to move into management consulting to work with some different organizations, leverage the skill sets from leading in the military, management, and then what I'd learned in the MBA with a couple of different businesses and build some experience up. So I applied for a number of jobs online. One of them I applied for looked really interesting. It wasn't a brand name. It wasn't a Deloitte initially or an Ernst & Young or a Boston Consulting Group. It was a brand new consulting firm that didn't have its name on there. So I applied for it. And my phone rang 10 minutes after I applied. This guy called Paul Eastwood, he's a managing director of the firm. He's recently sold it. And he rang up and he said, really interesting revenue. I'd love to come and have a job interview. I met him in a hotel lobby and he kind of pitched me on the idea of a consulting group that was working in fast moving consumer goods with the supermarket chains. I thought, hey, that's really cool. I had a second interview, which was I pitched one of my business ideas, which was about tagging cattle with RFID tags and using a drone to track them. I pitched that to him at a client site, at a major client site in Sydney, and I got the job. And I thought, hey, I'm going to take this. This looks really cool. So I finished in the Air Force on a Thursday, and I started on a Monday. But that convalescence of things came together in the last 2 weeks. I was almost stepping out into the wide unknown with nothing to go to, and I jumped on board. And I think that experience jumping into Paul's company shaped, like that really drove home my desire. I don't think I ever would have founded a company if I hadn't have seen how Paul built his consulting firm.
With Poland, you ended up there for only just about a year before you moved on to brand name in consulting.
So I actually jumped out, started my own company. That fell apart. I got poached into the Deloitte team. I worked at Deloitte for a short period of time. I had another run at a similar company, which ended up becoming Swoop Aero that I founded. So kind of both Paul at Poland and then the Deloitte partner I worked with were both like, hey, you should go out and try your thing. If you're passionate about this business idea, you should go and do it. And so I got pulled. I was at the small consulting firm. I moved into Deloitte. The whole time I was trying different things. I was the CFO of a services startup that became a crypto company, and I didn't understand crypto, and I left, and the guys made, a brilliant company out of it and stacks of money. I tried 2 or 3 different things. I went into an accelerator program. We dropped out because the idea wasn't good enough. I went back to Deloitte. Like I used to bounce this idea that I was having about chemotherapy medication drone delivery with the partner. On a Friday Arvo, we'd sit there and talk about it for 2 hours, and he'd be talking to me about his latest windmill design, and I'd be talking about the drone delivery company. And eventually that convalesced into founding the company and jumping out and into the startup full time.
So did you found the company with this guy that you were bouncing ideas off?
No, I didn't. So while I was working at Deloitte, I met a robotics engineer, and we got asked a question that came from a state government about could a drone deliver cancer medication in the Australian outback? For anyone who's listening, out of a place called Mount Isa, actually in particular, it's a mining town quite famous in Australia. And it was solving this problem of people who needed chemotherapy treatment had to come in, stay overnight, have a day of treatment, stay overnight for a day or two and drive back. And they were spending more than 50% of their time away from home. And if we could deliver the medication out to them really cheaply to their local doctor could administer it, and they could be staying at home instead of having to, be at the hospital half a week every week. And that sounded like a really interesting challenge to solve. And so that sounded exciting. I like aeroplanes. My business partner liked robotic aeroplanes. That sounds cool. We looked out into the market and everyone was taking a toy and building a delivery drone. And I thought, hey, we had to take the Hercules and the systems that made the Hercules fly all over the world, shrink it down with robotics into a 30-kilogram aeroplane that runs on electricity, that's built out of plastic. Then use software and the early forms of pre-LLM artificial intelligence to build a software suite around that did all the jobs of the maintainers and all the big Air Force crew. We could shrink that down into a single person doing that job with software. And so we founded the company on that premise that we could make access to the sky seamless, and we would do it by having a full stack hardware and software company that wrapped a small robotic aeroplane in artificial intelligence to software, and we could deliver anything anywhere in the world from anywhere in the world with an iPad was the original vision. And when we got there over a 7-year period, it took a little bit longer than I thought it would, but we did it in the end.
I mean, on this show already, you've shared some very wild ideas, but you ended up executing on this. But just to stay on that idea stage a little bit more, Amazon, for instance, has been talking about drone deliveries for a long time. Is this exactly what you were doing almost 10 years ago? Like literally taking products and delivering them by drones?
Definitely. So we delivered 2.4 million medical items by drone while I was the CEO of Swoop. So that's kind of from day one through to when we restructured the company. But most of it happened over just towards the end as the technology got to maturity and we really ramped up our operations. We had a very, very clear idea of the product requirement that we had to build at Swoop Aero. From day one, we understood what moving 2 kilos of chemotherapy medication looked like. We looked into the market and we identified really quickly that most companies were thinking about delivery.
Yeah.
And I knew from Holland Consulting actually that if trucks are empty, you're losing money. And so we did some work with a big 3PL on route optimization for trucking and how do we make sure we're using the same trucks for inbound and outbound logistics. And so just conceptually, the airlines run like that as well. And if you've got an aircraft that flies out and delivers something and flies back empty, you're going to lose money. And so just from a unit economic model perspective, we realized we had to build a system that could run logistics, not just delivery. We could pick up things and we could drop them off from anywhere to anywhere. And we identified that the pathway to market was via healthcare because there was a real need in healthcare. Even in Australia, if you were 100 kilometers outside of a capital city, your ability to access primary healthcare, so a vaccine, anything prescribed by a doctor, it's no different between being there and being on an island in Indonesia or being in Malawi, as it happens. The delivery of healthcare, you can't get primary healthcare within 24 hours back in 2017. And the major blocker is transport. In some parts of the world, it's impossible to transport the goods to and from an area. In Australia, it was just too expensive to pay a truck and a driver to go and deliver it. So they only delivered it once a week. And so we identified there's this unique problem all over the world where the logistics infrastructure, as it stands today, wasn't serving the needs of everyone. And so when you look to a logistics future from back in 2017, autonomy was going to be big. And so we all know that autonomous cars are coming, autonomous trucks are coming, but the technology was starting to open up air as a domain. And so you think you have air power, sea power, and land power. Land power is cars and trucks, things moving things via the road. Sea power is moving things via the sea. But what wasn't being done at a huge level, other than using helicopters, there was no cost-effective way to leverage the air. And when you integrate moving things by the air into a logistics network alongside autonomy, you're going to have a transformational effect across the whole network and what the cost structure looks like. And so that's where we started to play. We had a unique customer set of requirements. We built out a product document set, which we delivered on over the next 6 years. Some of it was automated at the start. Most of it was manual. We had people doing the tasks. And over time, we built that into the software stack. And at the end, we had artificial intelligence making a lot of the decisions in there with very, very little human interaction. And then we got the product into market. And so I think where a lot of these big companies that just spend $1 or $2 billion getting their drone logistics or drone delivery program off the ground is they just didn't go to the hard parts of the world and do the hard work. We put boots on the ground in Vanuatu. We put boots on the ground in Africa. We had paying customers. We got paid. Our first customer was the Vanuatu government, UNICEF, and they paid us per delivery. And if we didn't deliver, we didn't get paid. And that brings about, when you're in the real world with paying customers, the way you think about product requirements and developing that and how it projects into the future is very, very different.
That's a very interesting point. I just wanted to dig into those early days a bit. You went on to this fantastic run. But before then, let's talk about the early days from going from the fantastic idea to the first paying customer, the Vanuatu government. That could not have been easy. I would like to hear more about how you made that transition. How long did it take? What did you go through?
Yeah, definitely. So we founded the company in August 2017. And we had a couple of people, we all put some money and we started building out prototypes of aircraft. This is a really interesting consideration of how people leverage the network to help build. And so I had a colleague or a friend and someone in my network. He now runs a pathology company, but at the time he was running operations for one of the big pathology companies. And so when I said, like, I'm looking at running a medical drone delivery company, do pathology movements, like you have cars that move around and do stuff. Is this a problem? And kind of understood that there was a problem there with pathology logistics. Getting blood samples from a hospital center back to a lab to have them analyzed was a big challenge. And so we understood that was a problem, and we understood that it was a delivery problem. And so what we had was a very good set of product requirements. And we just built our initial prototype, which was okay, but then we built our first initial product that met all those customer requirements to it. And so then we understood we had to be able to fly in rain, in certain wind conditions, A, B, C, D, like a whole range of product requirements. We were able to build to that. It was a bit agricultural. It wasn't really pretty, but it did the job, the core job of the product requirements. And so then UNICEF and the government of Vanuatu released an RFP, and I thought, hey, I've got to get boots on the ground here. I've got to go see what it's like. So I flew to Vanuatu for the first meeting, and I was the only person that turned up. Everyone else dialed in via shaky web link, and the video was cutting in and out, and they're talking about product requirements. And I got on the ground, though. I met the people, I met the healthcare staff, I learned about what their core problem was. And so we bid on the tender. I'd met the people, and we won based on technical capability. Our aircraft in the system met the customer's needs. It didn't look sexy in the brochure, but it did what the customer needed. And I think that was a big part of the DNA of how I built Swoop and now how we're building Vissibl. It's about meeting the customer's needs. It's not about making sexy decks or good pitches for marketing. How do we make sure we're zoomed right in that customer requirement? And so there was a lot of time, a lot of late nights spent in garages, soldering, a lot of calling up people, pitch decks, meeting people at cafes for coffees. We raised $100,000 of that was angel capital back then, 100,000 Australian dollars, so 60,000 US dollars. And we built the core technology with that. We've got a group of supporters that love what we're doing and around us and used Uber Eats coupon arbitrage to buy them fish and chips once or twice a week. And that they were the team events, back in the day. Um, Eventually, we quit our jobs, took a little bit more capital on, and we got into an accelerator program, and it all came together then. We won the tender while we're in the accelerator program, and then that program finished, and I sold my house and moved to Vanuatu and started delivering.
What did you see that made you confident enough to sell your house and make the move?
I mean, I knew that I was new to the venture capital game, and so the part of the accelerator is going through the pitch process, but I knew that the customers were there. I knew that there'd been a number of people that attempted this in the past, and I could see what I kind of viewed was that there wasn't enough focus on what the customers actually needed. The technology was really cool, but I think I very strongly believed that we'd got it. We'd identified what the core customer requirements were. We'd actually won this tender, and UNICEF's a big unilateral organization, and I thought, we go off and do this, and at a minimum, I'll be able to say I've done something amazing. I've delivered the world's first vaccine by drone. And so that, from a personal perspective, is probably worth the risk of going and doing it. But I think it could be much bigger than that. Now, I don't think anyone who wasn't the founders plus one or two other, maybe five other first believers who came and helped us really believed that. I know my parents definitely were just like, he used to fly 70-ton aeroplanes and he got an MBA and now he's back to toy planes. Until we got an article in the New York Times when we made that first delivery. That's when it kind of clicked for everyone else. I thought we were onto something. It was interesting. I could see the convergence of technology. I knew the industry very well. I'd had enough customer conversations with people all over the world in health, in pathology, in logistics. I had enough of an understanding that said, this is a real problem we're solving, and it's a meaty problem. And I think we can go and do it. And so we'll give it a shot. And if the worst thing happens is that I've sold my house, so I have to come back and rent somewhere, but I built a company with the first people in the world to deliver a vaccine by drone. That's a pretty cool thing to have done. As that was my mindset, when I sold the house and moved overseas.
I've seen something you wrote where you said you did not know how to sell. For someone not knowing how to sell, you achieved a whole lot in enterprise sales.
I know how to talk. I do know how to talk, but I didn't really know how to sell at all. And so I went and did a sales course. Probably the most powerful thing I did as a founder was learn about what's the psychological process behind someone buying a product in B2B. And so it was a B2B sales course and learning about buyer journeys. And I think the big learning for me, and this was very, very important for enterprise sales, is we had different people that we had to sell to in different ways. So often we had the user of the product was different from the decision maker, who was different from the person who was paying from the product. And so learning how to talk to each of those people and the messaging they needed to hear to make that buying decision and what the journey looked like was really important. I very quickly understood from that the thing we were going to really be trading on to make a sale at the start was some form of trust. And so you've got various ways you can establish that. And I had the luck of having been an Air Force pilot. And so that gave me some credibility. And so while in 2017, drone technology was going through a spate of crashes.
Hmm.
Every postal service around the world, there was a video of their pilot program crashing or landing in the water. And so I kind of thought, well, I can take the trust I've established some credibility as a founder, bring that to the company, but then we have to over deliver. I'd learned what the sales process looked like, but what we had to start doing was leveraging trust and then starting a flywheel of trust to build credibility as a founder, but then transition that to the company as we grew out and maintain that. It's an interesting process to have gone through, but I think we got there. I think we did a good job in the early years.
You've talked about us. What would you say are maybe the other 2 or 3 top tips that every founder thinking about enterprise sales needs to do?
Make sure you're building a product that your customers love and talking to them in a way that they can understand how it's solving their pain. I think that's the main thing. When you're talking about a drone delivery network, the drone flying around is really cool, but ultimately they want to know how it's going to give a user on the ground interacting with that, how it's going to give them time back, or for the company that's buying it, how it's going to make them money or how it's going to enable them to make more money or offer a better service to their customers. Being less excited about the technology that sits behind your product and really, really passionate about solving the problem, I think is kind of the first tip. And talking to the customer and deeply understanding how you're solving their problem. My second kind of thought about that is get on the ground with the customers, meet them in person. One of the best things I did early on was I had a tour of a pathology lab. We're trying to solve, can we do healthcare deliveries? Like, what does your business actually look like? What are you doing day to day? What are your pain points? What do you love about your job? I looked at pathology. We looked at all different areas of healthcare. I went to warehouses and stepped around parking lots with operations managers who were trying to think about how they could make a drone land in their yard without disrupting the traffic flow. Went to Vanuatu, I went to DR Congo, I went to different parts of the world and got on the ground with the people who were going to be using the product and with the buyers to deeply understand them and show them that I genuinely cared about solving their problem. I think they're probably the 2 things that you want to look at. I mean, in person, I'm a massive fan of get on the phone, meet your customers, get boots on the ground with them, understand their problems.
I mean, are these enterprise sales tips, are they related to your success in fundraising as well? If I recall correctly, over the journey with a Swoop, you ended up raising over 30 million. What
Yeah.
were the factors? What did you get right to be able to achieve this fundraising success?
Definitely. I think when I think about it now, when you're fundraising, it's kind of, is there a huge market opportunity? Do you have a concept for technology that can actually solve that problem? And can you build conviction with investors that the technology can actually solve it or the product can actually solve it? And then is there a founding team that can actually build that technology to make it happen? And so when you think about fundraising really early on, what's the problem look like? Is it a meaty enough problem? Do you believe that technology is going to solve that or your product's going to solve that? And then do you have a team there that can actually execute on that? And so I think from our initial fundraising efforts, we raised some angel capital. We got into an accelerator program. We did the pitches. For us, proving that we could get our first major customer on board, I could in fact sell to UNICEF and actually on sell. So we did in fact get the Vanuatu government to sign an MOU to continue using our services, and we continued beyond the initial pilot doing flights and operations in Vanuatu. And so that being able to, okay, we've got a small team together with very little capital. We've won a major contract and we've impressed an enterprise client and a government enough to sign an MOU to continue operations. That was the key thing that got us through to what is now a pre-seed round, but at the time was a seed round of capital for us to build out an initial team and go and keep on doing this and bring in the early customers on board. And so I very systematically thought about it. We wanted to win every competitive tender for medical drone delivery that was released. That was
Wow.
broadly what we did in the first 3 years. So we won the first competitive tender. And then because that was such a success, it was a success for UNICEF and the government. And it was a success for us. The technology worked. And so then we knew there'd been other trials around the world. We actually went and worked with these organizations, said, hey, you should run competitive tenders. And here's what
That's
you should put in
globally.
them globally. And if we win them, great. And so then there are a series of other global competitive tenders that came out. And so our goal coming out of Vanuatu was here are the next set. We had a commercial partnership with a pathology company in Australia and a healthcare company in Australia, which is great for the longer term in the developed world. But what we needed to do was every time an opportunity came up to get our technology into market with a paying customer, we had to win it. And we had to win it based on the best technology and getting over there. And so we proved to our investors that we could not only win an enterprise customer or a government customer, but then we could on-sell to them. And that's a really powerful thing. We actually on-sold to the Vanuatu government. We on-sold to them in the start of 2019, and then we raised a seed round, and we did churn them mid-2019. They're the only customer we churned between mid-2019 and mid-2024
Wow.
was this customer, because we hadn't quite worked out how the development agency funding cycle worked. And we worked that out later on. But at the time, we hadn't quite nailed. We had the buyer and we had the decision maker, but we didn't have the payer. And we worked that out. They were all different organizations. And ultimately, what we did is we had public private partnerships, three-way public private partnerships. And that's how we deployed into the emerging world. And then once we got into the developed world, the partnerships became much more streamlined and commercial. But the ability to get your first customer and then convince them to continue using the product was very powerful when we raised our initial round of venture capital.
Amazing. And then you went from 100,000 the pre-seed. How much was the seed round and then Series A, Series B? What was the breakdown
Definitely.
of the journey there?
So we raised 1.35 million. So we actually in total in Safe Notes, including the accelerator, we raised about $200,000 angel capital. We raised $1.35 million at what was our seed round, 4.7 at our Series A and 16 at our Series B,
Amazing.
Australian dollars. So
Okay.
that's, yeah.
That's still over 20 million US dollars.
Yeah, and then we extended our Series B into the restructure through 23 and 24. And so had an interesting journey, three really strong rounds of growth. We saw the venture capital market over a number of rounds, and so we saw the challenges of that's a very small amount of money to build a drone delivery company. Over the same amount of time, anecdotally, Google spent $2 billion building a drone delivery company. And so we were able to do a lot with a tiny amount of capital by having a laser sharp focus on the product and keeping our product in the market with paying customers to iterate on it, just like you would a piece of software.
You kind of alluded to it, but you went from raising multiple rounds of funding in a relatively short period, achieving all the commercial success, winning all the enterprise clients. But then what went wrong? At what point did things start to break?
Deep tech is extremely hard. And so we probably had any number of products within our tech stack. So we were full proprietary software stack, full proprietary hardware stack, and then we manufactured the aircraft ourselves. And then we delivered a service. So we were building airplanes. So we were Boeing. We manufactured them. So we're the Boeing manufacturing department. We used our own avionics. So we're all the suppliers to Boeing. We then operated the aircraft like Qantas. So we're a Boeing and Qantas at the same time, which is an extremely complex thing to do. There would have been 5 or 6 individual products within that stack that
Yes.
if we had have applied to a big market, might have been a venture backward business on their own. But I think full stack hardware companies are extremely valuable if you get it right. And that was always the upside. And that's why Google and Amazon, as an American company called Zipline that works in drone delivery, or even Tesla is a full stack company, SpaceX is a full stack company. A lot of these very, very successful, massively complex companies, when you're full stack, is the only way to guarantee your quality and your output and guarantee your ability to control end to end of the product and maximize your return for the overall technology. We adopted that strategy. That was extremely difficult. We kind of had a compilation of events. We had a team work tirelessly through COVID during a lockdown period where we kept the office open, we kept the manufacturing line open, and we grew the business substantially during all the COVID turmoil. And we had large lockdowns in Australia. where the only thing the team could do was come and be part of this culture at work. They were very fatigued coming into 2023. We introduced a new aircraft to service, which statistically is risky in aviation. When you're phasing out the old model of the aeroplane and bringing in the new one, that's a really complex time. You have two assets that you're supporting at the same time, working off completely different technology stacks, and you've got to keep them both safe. One crash, and we're grounded. The company's a failure. And so this is a complex time. We were ramping up manufacturing. Anyone who's read about Elon's manufacturing hell, we were doing that with a drone delivery company. We were building small airplanes on a manufacturing line, a full new digital manufacturing process with a new full product. And the venture capital markets collapse all at the same time. And so think about it. This was all happening at the moment Silicon Valley Bank collapsed. And we saw venture investment decrease by 80% in a quarter and 100%. All of Australia's venture capital investment stopped unless you were Canva or Safety Culture or the unicorns. Outside of that, there was essentially no funding. And so this was the most capital hungry period of the business. We had a tired team and the funding stopped, the music stopped. It was very difficult to pull us off needing heavy venture investment and get restructuring the business in a way that kept us alive and could keep us back on a growth track without, a continued deep venture investment. It's very hard for a hardware company to do that.
Like you said, if you get it right, it's to the moon, right? But so many things could go wrong. But
Yep.
before I will come back to this, but sometime before things went south, you received an $100 million acquisition offer.
That's right. So as we were coming towards the end of COVID in 2021, we identified there was an opportunity, and I think this has now exploded, but this was the start of the defense complex realizing that commercial drone technology could be really valuable. And so we were looking out into the market for organizations that could partner with us to offer, a two-tiered solution, so a smaller aircraft and a bigger aircraft for government and defense, as well as into the commercial sector. And we thought that, and now we're seeing there's multiple unicorns in this space now. But rewind to 2021, we're right at the forefront of that. And so we got an opportunity to be acquired. It was a large opportunity. At the time, we hadn't raised our Series B, so our total capital raise was $6 million. We had a big capital acquisition offer on the table. And we had to choose between that and raising a venture round and continuing to build. And I think, we knew that we could go and deliver on something. And we actually very open with the team about this. We had a lot of due diligence. The team knew that this acquisition offer was on the table. We knew what the upside could be, but it meant that we would be kind of pulled from our mission, and we weren't going to be running. We were going to be absorbed as to being part of another company, and we made a decision that we were going to build it on our own, and so we rejected it. The documents were complete. The board made a decision that the upside potential for our shareholders was greater if we continued on our own mission. And just before Christmas in 2021, we said we don't think we can go ahead with the deal, and we're going to raise a venture capital round. And we went and raised a venture capital round and did some amazing things over the next 18 months. And we achieved more than you ever could have with an amazing group of people. And ultimately, we failed. The business, the company as a business failed and had to be restructured. And the new group that are running that and running with it are going to be really successful, I hope. But we didn't achieve our vision, which is an interesting thing to think about. I also, as the two founders, we turned down a lot of money. And I'd make the same decision again, which is the funny thing with a lot of time to think about it and reflect on it. You'd make the same decision. We made the correct decision for all the shareholders at the time. And despite the allure of money, it wasn't why we were building the company. And I don't think it's why you build a company. You build a company to get a group of people together to do something amazing. And I'm still focused on.
You turned down the acquisition offer because you and the board realized there was a higher mission, there was more prospects as an independent company, but that didn't work out. What happened?
That's right. We raised the venture capital round and we had an amazing kind of 18 months through to mid 2023. And that's kind of when you raise a venture capital round, you aim for 18 months to 2 years worth of capital. We raised a little bit less than we wanted to. And then what happened was we saw the kind of venture capital winter of, late 2022 into 2023 kicked in. And so as a deep tech company, we're developing hardware and software. We were rolling out the manufacturing line. We kind of already talked about all the complexities of these things coming together, and it's quite expensive. And so we looked at it and we said, okay, could we get an M&A together? And I couldn't get my board at the time to approve an M&A with another company that would have seen us continue on as a joint group. And so then we raised a bridge round and we thought we'd use that capital to work out how do we make the business more capital efficient and wean a deep tech company off the need for a huge amount of venture capital to continue through to profitability. And we almost got there. We got within a couple of $100,000 of the money we would have needed to bring us through and to run us into profitability. And I kind of, if you imagine that, people talk about when you build a startup, you jump off a cliff and you've got to build your airplane on the way down. And so you're falling, you've built the airplane, and then you kind of get to that quintessential pilot scene where the pilot's there and they're pulling the stick back and they're slowly pulling up. And you either just graze the trees and pull up and the pilot's the hero, or the wingman of the pilot, usually the best friend, has to give the wave goodbye and they roll into the ground. And I think that's kind of what happened with us is we just couldn't quite make the pull up happen. But we did a whole lot of things to try. And so I think maybe it's worth chatting about if you want the kind of things you've got to think about and do to take you off the venture capital train and reposition a business for not needing more and more capital.
Will be interesting. That is core to what the 23 Mile brand is. You know, getting founders to think of that initial capital stack, most of the time venture capital, which is absolutely essential. To your point, there's no way you can do deep tech without a lot of capital. But that winning process has to happen at some point. So it will be great to get your insights. For other deep tech companies, just everyday SaaS businesses, that transition from venture back to profitability, the lessons and insights from there will be very useful.
I think it all really comes down to capital efficiency. And with your background, you'd be deeply understanding this. And I love the mission at 23 Mile, as you know. And so what we saw is that we'd built this hardware and software ecosystem. And so we had some ongoing technical requirements that sat behind that. But at the core of our business, we use capital to buy aeroplane bits. We built aeroplanes. We then took those aeroplanes and used them to operate an airline. They were very small aeroplanes, but if you think about the model in that way, that's how it works. And so we had the initial capital requirement to build the airframe. We then built it. We then operated it as an airline selling tickets. Imagine selling tickets. And so what that meant is the time from when we had to spend the money to build the aeroplane through to the time at which we had sold enough tickets to pay it back was kind of 18 months to 2 years of time. Now, if you think about an airline industry, Boeing build it and then they sell it and they make money and they can recycle that money. The airlines buy it, but they use leveraged finance. They borrow the money like a car to buy the airplane off Boeing. Then they pay it back on a monthly basis and they hope to sell enough tickets every month to pay back that airplane until the lease is due or the repayments are due on borrowing that money. And so we were using equity, venture capital we'd raised to run this process. And that means that there's a huge amount of time from when we take money into the business through to when we pay back that asset and start generating great net margins the venture capitalists like to see. It's longer than the amount of runway we had. And so we had to think of a way that we could streamline the business down to improve that capital efficiency cycle. So the time we spent money on building an aeroplane through to when it paid back the costs, through to when it started generating us profits. And so we started a restructure of the entire business and its processes to enable this to occur. So we ran drone delivery networks. So the first thing we did is we had to assess which of our customers were profitable and which ones weren't. And the ones that weren't actively contributing money back and paying off the airplanes fast enough, we had to shut down. We sold some networks to our customers. So other customers that were already leasing aircraft off us, we took a network that we were running. We said, hey, you operate that and you pay us up front for it. So you can take the long tail value of that, but we're going to improve the capital efficiency. We're going to get a faster return on investment from that. And so then what we transitioned to was operating, rather than a drone logistics company, we operated a hardware as a service business. And so we took assets that we'd built. We were then able to charge customers an upfront payment to take ownership of those assets on implementation costs. So we could very quickly return back the capital on what it costs us to build the asset. And so what that did is it brought the time back from building the asset through to paying back the asset from something like 18 to 20 months back down to 5 months. So we could recycle the money faster, would pay itself off, and then future money could go back into building more assets to grow the business. We then changed our contracting model onto something more like a software as a service business, so a higher margin with a range of services you could pay for on an as needs basis. So rather than bundling everything into an all-in cost, we got a better margin out of our payment system by having a core software service that we offered and then charging for other services as they were needed by the customers. And that meant that if a customer needed a spare part or an additional service, they paid us an additional amount on their monthly bill, and then that paid back. So the cost of running a service when we were operating the assets came down from a 3-month payment cycle. So we ran the business for 3 months, and that's when we got paid. Down to we were paid in the same month, and ultimately got through to being paid month ahead. And so that
So, I mean,
transition.
just to interrupt you there, it seems there are two themes I'm picking up there. A big one is working capital cycle, which the average entrepreneur doesn't think of when they're starting out. And then the second is vertical integration, which if it works out, like we've seen with Amazon, Google, and SpaceX and Tesla, it really works from a venture return, but it means there are more things that could go wrong. Am I right?
That's exactly right. And what you said there at the start, when you founded the company and as we built it, we never had to think about our working capital cycle. It was, hey, we're always going to be able to fund that with venture capital, just grow at all costs, which is quite expensive with physical assets in hardware. And so when there was kind of a funding winter where that venture capital wasn't available, venture debt was an ascent in Australia almost unattainable. You find that there's no way to scale the business without a huge working capital requirement that's funded by venture capital. And so that was something we weren't taught to think about at the early stage. But if you were scaling a hardware company again, or even a software company, when you're thinking about AI costs these days and compute costs, you want to very carefully think about what that working capital requirement is and how big that pool has to be for you to scale the business. We got that wrong. That second bit you've talked about there about that vertical integration, it was really important to think about, and we had to go through this thought process. But if I was building it again, I'd be always thinking about where in this stack can I quickly monetize? Where can we hit the pause button, chop the bottom part of that fully vertically integrated stack off, and quickly monetize in the stack? That'd be really important to be thinking about. We didn't think about that much when we were building.
With the benefit of hindsight, and with you now building another startup, what would you say are the essential things founders need to do to build a startup that is a great acquisition target?
Definitely. I mean, that's a really complex question. You can think about acquisition from all different lenses. I think here's something, and I love that you talked about failing. I call it failing forward. Or if you like a Buzz Lightyear methodology, you could think about failing with style. And that's why I love to share this. Here's something I think when you're building a business, you can think about it, you're building up the stored value in there. And it's not about necessarily revenue growth or margin growth. It's not about the amount of money you're making, but it's about the strategic value of the technology you've created. That's one type of tech startup. The other type of tech startup is purely about customers and market size. And so how many and how quickly can you grow customers and market size? It's then about packaging which one of those two you are with the right messaging and finding the right investors to back you on the journey, and then identifying the types of organizations that are going to want to buy that off you. And so I think very broadly in those two buckets is how I think about how you might think about getting acquired. You can build a deep technical capability with a fantastic technical moat, which is hard to replicate for any number of reasons. And the technical IP is the value store. The other one is the value store comes in how stuck your customers are to the platform. Have you built a lot of them? Are they paying well? Are they sticky? Are they loving the product? I think where we went wrong at Swoop was we didn't pick one or the other. We had investors and we had potential acquisitions that were kind of across the two, and we didn't have a clear messaging set about, hey, this is why we're extremely valuable as an IP store. We've got a deep technical moat that is making us incredibly valuable, which I think was the truth. The value of the organization was held in an amazing engineering team and a product vision that had been executed on with a deep store of knowledge in there. What we blended that with was a revenue growth profile that was largely dependent on market adoption. So we're in the pioneer and early adoption phase of this technology, and it was incredibly hard and we had a complex revenue pathway with that vertical integration. And so what we saw is that we had that mixed messaging, which was great at one point in the market. We should have doubled down on, hey, there's a huge IP value store here. And we could have trimmed down the team, slowed down some of the tech development, slowed down our burn
Yeah.
because we knew that we could focus on that IP value creation. But we blended it with, hey, we're going to continue revenue growth going here, and we kind of diluted out the messaging of the IP value store with the revenue, and the revenue stopped growing at VP rates. We plateaued on revenue when we were growing at 250% year on year, which actually should have been communicated as that's okay because all the value is stored here in the product. We didn't get that messaging right when it came towards the end of the pipeline of restructure and sale of the business. And so for founders, you want to think very carefully about where you're investing and what your acquisition value store is coming from. Is it coming from IP and product with a deep technical moat, or is it coming from market and customers and stickiness of the product and the revenue growth associated with that? I might not
Um,
be right.
I have a Venn diagram that I use when speaking to founders that I'm working with. It has those two you've talked about, but it has a third one, which is people. And there's something you've said, I've seen you talk about, which is speed of execution. What do you think about that as well as one of the values that a small company brings to a bigger one?
Yeah, definitely. I 100% agree there. I think the combination of the people who've made it, and I've got this theory about your speed of learning or your rate of learning being a core value driver for the business. And so we thought at Swoop, with the team we had and the ways of working we built and our operating rhythm, as I call it, the meetings a cycle is how we quickly implemented and iterated on physical product alongside software. The more customers we could get, the more flights we could do, the more quickly we could integrate that learning in. We ended up with an exponential learning growth rate. And so I think that's a really good point in that the team, we're seeing this more and more, particularly in the AI space and deep tech space. You have higher acquisitions where the team becomes a core component of the value of a business. And so that's actually a really good point. No, I think maybe it's really you need a great team there, and then you can pick either one of those messages. Is the great team going to market very, very
Yeah.
rapidly, or is it building this amazing IP very, very rapidly, which you can't replicate? Love
I
that.
love it. I love it. I see why, you and I have had so many conversations about exits and before this.
100%. I was going to say maybe we have to do a deep dive into just one of these sections. I'd love to do that.
What we've not talked about is the fallout, the impact on you as a person. Tell me about that.
Definitely. I think one thing that isn't spoken about loudly in founder circles, but it's spoken about very openly with people who've experienced it, is the impact of when things don't go well, and that combined with having been on this long and arduous journey. And so when I finished up with the last company, kind of made the decision I'm not going to go on board and work with the new owner. I need some time off. I kind of think of it now as strategic rest. I'd been this go-getter. I was an Air Force pilot, management consultant, founder the whole time without a break. It's kind of there's this idolization of like grit and working through holidays. I've got a suite of photos of me on holidays, on the phone, working through a honeymoon, building all the time without any rest. And what I found was that after 7 years of that, I was completely exhausted. I had no fuel left in the tank. And so I made the decision this year to actively focus on achieving growth. And what that means is to experience growth, you need to have pain you've experienced plus reflection equal times reflection equals growth. And so if you have no pain, a lot of reflection, you don't grow. Or if you go through a really painful experience, which let's talk about the whole journey in terms of a lot of pain, a lot of hard work in there. It was time to reflect on that. So I spent 6 months this year purely focused on reflection. That started off with health. So I lost 30 kilos. I got back to the gym. I love lifting weights. I got back into the world. I started doing things. I started meeting people. I started learning again. I think I've got a reading list I read a book a week for the first 26 weeks of the
Wow.
year, biographies of amazing people who've gone through hardship, Queen Victoria to Winston Churchill, Nelson Mandela, even. But I felt like I had to reconnect with what the future could be. And so I'd gone through the first 6 months. I started to reconnect with the startup ecosystem, started to feel like I've got some curiosity back to build again. But it took that long. I thought maybe it'll take a month. No, it was a slow process to get back on board, to get your body to support your mind, being ready to go, to disconnect your mind and be able to really abjectly think about, hey, what went right, what went wrong.
Yeah.
It was a fantastic experience. All these amazing things happened, but how do I know what I did right and what I did wrong and objectively think about it and be really comfortable to talk about it.
Can you share maybe two of the toughest things that really happened during that whole 7-year period of growing and maybe during the hardest times there?
One thing that I wasn't good at was managing the board through challenging times. And I think, for me, I was very much like a stand at the front, lead by example type leader, and you kind of get people aligned behind where you're going. What I wasn't so good at in my younger years was the quiet conversations that you need to have to bring a group of people along on a journey. The toughest things I found were where, as a CEO of a company with 100 people in it, you're very alone at the top and you've got a board that have a lot of expectations of you to deliver with this big company and this capital bunch you've got sitting below you. And then you've got a company that are looking up to you for leadership, but not necessarily for you to be part of the team anymore. You're kind of sitting there with two sides of this organization, both looking to you to achieve and grow in a way, and often with very, very different views about what's needed. Your team are often tired. They need to feel like they're included. They feel like they're heard. They feel like things are going to get better for them and that their workload's going to decrease. And you've got, a board representing shareholders that want to return. Rather than pinpointing a specific time or two that are toughest times, I think when those two pressures came to a head, that was the toughest time for me as a CEO. And you're the only person there in the center of the sandwich to manage them. That's when the times are really tough in the company. What I really wasn't good at was the quiet conversations that needed to happen to alleviate that pressure. And I think I'd be much better at it the second time around. But when that pressure came to a head from both sides of the sandwich, that's when they were really tough.
That is it. People don't want to talk about it. But let's move on to your, I call it second or third offering now. You've recently joined as CEO founding team of Vissibl. What is Vissibl in a nutshell?
Vissibl is an artificial intelligence native operating system for compliance. And so what that means is we take away the pain for companies of getting certified against regulatory standards and then maintaining compliance with that standard 24 hours a day, 365 days a year.
Amazing. And how's
It's been an amazing journey. I met the CEO and my co-founder, Sean, while he was working at Google's drone delivery program and I was running my own. And so we were kind of cousin competitors. I often joke that I should have got Sean onto my team at the time. But when I decided to take a break and move out here to Dubai, he was the first person I had a coffee with. And when I met him, I was like, wow, I would love to work with you. Like, he's so full of energy. He's really passionate. He's an amazing guy. But he said he's working on artificial intelligence for compliance. And I thought, I've just come out of 7 years running a tech startup in regulated industry. I don't think I want to do that again. But it dawned on me that it was an amazing opportunity to solve that problem with artificial intelligence. And so I jumped onto the team. It's fantastic. We've got a third co-founder called Hitesh. He's an amazing software engineer, has built and led software teams from Netflix in Australia through to developing an app in Russia that has 500 million downloads on the App Store. We've onboarded our first customers and we're growing out as a team, and it's exciting to be back in that early phase.
If you could describe entrepreneurship in one word, what will it be?
Tough.
What keeps you going if it is tough? And backbreaking, as you've described it, what keeps you going in the same entrepreneurship space?
It's the opportunity to do something amazing. I like it because it's tough, and if you're successful, you can do something incredible. Not even about money. It's just you
I mean,
can.
what's one thing about entrepreneurship that you see your founders realize and you wish they did?
You'll appreciate this, that I think it's a marathon, not a sprint. I think that's the toughest thing that early stage founders, it's like all guns in, eventually you'll run out of puff. And you obviously know about this at 23 Mile. It's all about the last little bit, isn't it?
I can talk all day. So that's a topic for another day. Shout out to Opus where we met. What made you join Opus a few months after coming to Dubai?
That's right. Listen, when you're building a company, I talked about that, the toughness of being on your own in that kind of pressure sandwich. But the thing that can help is being surrounded by amazing people. You want a cohort of people who understand the challenges, who want to listen to podcasts like this, who are trying their own things. And it's like having a peer group of people who know what you're going through and want to help you. and have a community like that. And Opus has built that. And that's why I joined. I wanted to be surrounded by some amazing people trying tough, incredible things, failing, succeeding, it doesn't matter. You're all going through that journey together. And Opus was that group. And so I thought, hey, I'd say it's integral to getting me back onto the horse and back into founding a company again, was being surrounded by people who are all doing it.
I really love the community. Shout out to Sam, shout out to Pascaline, and hopefully see you at the next event. Thank you very much for joining me, and see you soon, Eric.
Thanks very much, Cody.